Good morning or afternoon, everyone, depending on where you're listening from. Welcome to FTSE Russell's webinar on the past 15 years of ESG indexing and what's next. The webinar is also brought to you with the support of Partners for Sustainability. They provide sustainability analysis for mutual funds and communication on sustainability. I am Nicholas Amelin, part of the business development team for Europe at FTSE Russell, and will be the host of this webinar. Before we begin, I would like to go over a few housekeeping items. Our disclaimer is shown here on the screen. Please take a moment to read before we begin. So firstly, this webinar is being recorded, and a copy of the audio recording will be made available to you next week. Secondly, at the conclusion of this webinar, you can view any of FTSE Russell's on-demand content, which is available right here in this event channel. And thirdly, we'd like to encourage an interactive session, so please post any question by the question button, and we will endeavor to answer these in the Q&A session at the end. The question box is anonymous. However, if you wish to type your name and or organization in the box before you ask a question, please feel free to do so. Today we are going to talk about how environmental, social and governance investing has evolved over the past 15 years worldwide and is becoming the new normal. We'll talk about the state of global ESG disclosure, the future trajectory and emergence of smart sustainability indexes. We'll end with a Q&A session. Our speaker today is David Harris, Head of Sustainable Investment at FTSE Russell. David is responsible for FTSE Russell ESG products, including the FTSE4Good Index, ESG ratings, and FTSE Environmental Markets Index. He has worked in responsible investment and sustainability for over 15 years. David is also Group Head of Sustainable Business at the London Stock Exchange Group. Interviewing David today is Ms. Sabine Dobely, Chief Executive Officer of Swiss Sustainable Finance. Swiss Sustainable Finance is an association that was founded in 2014 and currently unites over 90 members and network partners for Swiss financial service providers, investors, and other organizations. Its aim is to strengthen the position of Switzerland in a global marketplace for sustainable finance. Sabine Dobely is the CEO, and she has worked in the field of sustainable finance for 20 years in different roles. Firstly, I will hand over to Imad Atem, President of Partners for Sustainability, to give a brief overview of their organization. Imad?
Thank you, Nicolas, for your introduction and kind words. I would like to thank FTSE Russell for this joint webinar, especially David Harris, Laura McCrackley, who out of Sydney has arranged this webinar, and you, Nicolas, for making it reality. Sabine, Head of Sustainable Swiss Finance, an early supporter of our firm, for accepting to moderate the Q&A session. Last but not least, all the participants to this extraordinary webinar. Our firm, Partner for Sustainability, aims to promote investments in sustainability funds for analysis and communication. We are pioneer in sustainability fund rating, as we started already 13 years ago with a methodology developed with the Swiss Federal Institute of Technology in Zurich and constantly improved it ever since. Our holistic approach includes not only the portfolio holding of an investment fund, but also engagement, research quality, and transparency. Today our data bank, the Sustainability Fund Finder, includes almost 1,500 funds, of which 700 have been rated, allowing a selection not only based on financial criteria, but also on environmental, social, and governance criteria. We offer analysis and communication service, as well as user statistics reports to investors, fund manager, corporation, universities, NGO, and opinion leaders worldwide. From a fund finder, we noticed that the large and increasing use of passive funds by investors has induced many large fund managers such as BlackRock, BNP, Legal & General, or UBS to launch recently sustainability index tracking funds. With the growing interest in sustainability, and especially with the increasing market shares of ETF, we expect a growing number of sustainability fund managers to select sustainability benchmarks in the near future. The awareness of sustainability in finance has been pioneered by FTSE Russell, as they started with the FTSE for Good Index 15 years ago, which developed over the years in a family of indices. This development and evolution of the indices structure tells the story of sustainability in finance. Mr. David Harris, Head of Sustainable Investment and responsible for our FTSE Russell ESG product, will tell you how the ESG concept, started as a marginal topic, is becoming today mainstream. David, the floor is yours.
Great. Well, thank you very much, Imad. And it's a great pleasure speaking and presenting virtually to all of you now. So what I'm going to do is give you a bit of history about how this whole area has evolved and what I've seen since from when I joined FTSE back in 2002 and how this has really shifted. I'll then zoom in and we'll talk a little bit about the different sustainable investment data models that we use here at FTSE Russell, as well as some of the challenges, particularly around the data and data disclosure and what we've been trying to do to try and help there. And then I'll finish by looking at some of the really kind of new and exciting evolutions here around what we're calling smart sustainability indexes, and I'll use a case study there. I expect that will take about 30 minutes, and then we'll finish with questions and which Sabine will, as we've heard, will moderate. So let's look at the history. Now, we started here with the launch of the FTSE for Good indexes, which have continued to evolve over the years. But we launched those back in 2001. And back then, the market was really very different. It was really dominated by retail investors. There was very little institutional investor interest in this whole space. And I should also say the criteria for the index back then was also very simplistic. There was very little information to be able to gather on how companies were managing and performing on environmental, social, and governance issues. That started to evolve and change. By 2006, when the PRI got up and going, and actually I guess the term ESG got coined, there were discussions by that point with institutional investors. There was a lot of interest, a lot of talk, but there wasn't a huge amount of action. And it was something which we were very keen to try and support that. Our chief executive was very involved from the outset, and we were a founding signatory of the PRI. Then those discussions started to get more serious over the following years. What we started to see was, particularly in active management, a growing focus in ESG, but still really quite limited, very limited to take up in terms of sustainability indexes. Now, kind of coming to where we are now, that is really starting to shift. We are now starting to see very serious, very significant institutional allocations. And I think the question here now is, what does ESG integration into passive look like? And I think, and in some ways, the kind of evolution of ESG provides some of the thinking there, but actually, thinking is also linked to the rise of smart beta. And so also, very soon after I joined, was a point where we started the launch of our first, the term smart beta wasn't really used then, but more fundamental indexes, with the launch of the FTSE RAFI series. And again, at the time, actually, there wasn't a huge amount of investor take-up. Again, a lot of interest in it, but there was very little in the way of allocations to non-market cap index funds. And that again, we've also then seen shift, and that more rapidly. And we now have a very significant part of the market is what often gets referred to as smart beta. So these are enhanced index funds where you build into the rules a series of approaches which can reflect certain kinds of active strategies. But as long as you can turn them into rules, then you can put them into indexes. We now have a range of different, very large range of different kinds of factor indexes, risk premium factors, which gets referred to as smart beta. And what we're actually seeing is the coming together of the kind of thinking and the kind of technologies and approaches that should be used in smart beta, but starting to use sustainability data sets, sustainability parameters within that. And I'll come back and talk a bit more about that towards the end of the presentation. So, we talk about kind of three different definitions really around sustainable investing. And we see a lot of confusion here. The first data model is what we call our ESG data model, and this is really about how the companies operate. So this is looking at how efficient are the operations of a company, how well does it treat its different stakeholders, how well governed is it. But that's very different to, if you look at the bottom here, what we've got is LCE, which stands for low carbon economy. But what we're looking at here is we're looking at goods, products and services. And this is much more akin to industrial classification systems. We're looking at what green industries does a company operate in. And this isn't about kind of a one-to-one mapping, because what you find in the industrial transition is there's actually a huge variety of different green sectors and subsectors that are emerging, and many companies having small levels of exposure to them, but often growing levels of exposure. So companies, whether it's companies like GE, Siemens, ABB, all these kind of industrial engineering companies, slowly growing the proportion of revenues coming from actually quite a range of different green industrial subsectors. And so now that's our approach. It's looking at revenues linked to green products. And then sitting in the middle, which really draws from both sides, looking at CO2 emissions. So on one hand, it's going to be looking at in terms of a company's own operational emissions, but this can also be in terms of their reserves, in terms of oil and gas reserves, which is then more to do with their products. So drawing from both sides. I won't spend very long on this, but this is our green revenues model. You can see here the 8 sectors where we're looking for revenue. And the next slide goes into the subsectors. We break down the revenues from over 13,000 companies across the 60 green subsectors. I say green, these are all different sectors or subsectors where there is a potential environmental benefit. There'll be a range of views around how green different individual areas are. If you take something like nuclear, clearly there are very significant environmental impacts from nuclear, and risks from nuclear. At the same time, it's also clearly a low carbon technology. But we break down and gather all of that data with around about 8 years history, so very, very detailed level breakdowns of revenues across these 60 subsectors, some of which you would regard as darker green, some questionably green. Moving on to the ESG ratings model. This is a kind of a high-level description of that model. We have 4 levels of data here: an overall ESG rating, which breaks down into firstly 3 pillars: an environmental, social, and a governance score. Each of those can break down into themes. We have 14 themes altogether running around the edge of this. And for each, and then below the themes, we've got the underlying raw data. And at the theme level, we have 2 different ways of assessing a company. One is looking at exposure, and this is really where we're looking at how relevant is a particular theme to a particular company. How material is it to that company? So it's not looking at how effectively a company is managing or performing in one of the areas, but how pertinent is it to their business. And there is a matrix for each of the different themes that defines this, which looks at the geography, looks at which different industries a company operates in to be able to categorise. So, for example, if it was under the water use theme, if it was a power utility that operated in Australia, power utilities particularly, they tend to be quite water intensive. It's operating in geographies where you've got more greater water scarcity, then that would push it towards being high exposure. If it was a sector, if we were looking at a software company that only operated in Stockholm, then its exposure under water use would be negligible. So there's exposure, and separately there's score, and then that's assessing how effectively a company is managing and performing in any of these individual themes. The whole idea of our model is that it's very objective. We don't want the data analysts taking any kinds of subjective decisions. So it's a very kind of transparent model where there's a series of data points, very clear rules on how those data points get aggregated and how they get weighted based on exposure. So, for example, if it was a financial services company, which would then typically have more kind of high exposure in the areas around governance and potentially less on the environmental and social side, then governance would overall have a greater weight. But it's all done through a very kind of clear rules and algorithm, which then computates that based on those underlying data points. So, I think what's quite interesting is a focus on the quantitative data. What we've done with our approach is to put most weight on the quantitative data and on the performance outcomes, which have the greatest weight within the model. Zooming in on, here's an example set of quantitative data points that we look at. You can see some data points will be applicable to all companies. So, for example, the amount of time spent on employee development, for example, at the bottom here, versus if we're looking at oil and gas reserves by type, and clearly we're going to be looking at oil and gas companies. Or equally, if we're looking, say, at fatalities, then it's applicable to around about 30% of industries, those industries that operate in, that typically have the highest health and safety risks. So, what you can then do with the quantitative data is then to try and assess performance outcomes. An issue is disclosure. So, here's two examples looking at power utilities and CO2 emissions per megawatt hour. So here, even here, you can see that we've got less than a third of companies globally providing this data. I should mention that we only use information that is put in the public domain. Up until about 4 years ago, we used private surveys where companies we'd write to companies and get them to complete the information and send it back to us. We changed that approach as we did not feel that was credible going forward. That it makes the data much more reliable if a company isn't just telling us, but is publishing it and making that information globally available. It tends to be much more due diligence put around the data when companies do that. So, although we will contact every company to check the data that our analysts have collected on them, we're checking what we've missed in the public domain, so they can only then provide us with links and information about information that they have published. And so, anyway, so you can see here that there's very low levels of disclosure in some really kind of key areas. So, also on fatalities, here we're only looking at companies which operate in sectors which typically have high levels of fatalities, and as you can see, it's just under 40% of disclosing. When a company has a very material area and they're not providing data, so we can't do a performance assessment, we will categorise them as being in the bottom quartile, along with those companies which perform badly. So if a company is not disclosing, the assumption is that is a risk for investors. You can do that, and here I just group things by by region, so to get a sense of the data. On the first set on power utilities, you can see the European utilities are the most efficient. Interestingly, on fatalities, it's actually American companies which have the lowest levels of fatalities, and as you can see, very much significantly higher in Asia Pacific. So, just sticking with that theme in terms of the state of global quantitative disclosure for companies, we thought it would be useful really presenting this data by country. So this is a data set of all large and mid-cap listed companies globally, approximately 3,000. And we said, well, of all of the large and mid-cap companies, if you divide those out by country, what proportion of these material data points are different companies disclosing? So we zoomed in here on, I think it was about 35 quantitative data points. So different kinds of data points be relevant for different companies depending on their sector. So we're not expecting banks to be providing data on their number of fatalities, for example. If it's an engineering company, then we would be looking at that. And what you can see is, yes, Europe does dominate here in terms of better reporting. Interestingly, a number of southern European countries, which I think I certainly wasn't expecting to top the list, come very high with Greece, Portugal, Spain, and Italy. And what you can see is that what's really lifted them up has been social disclosure. If instead we looked at the environmental disclosure, then you can see countries like Finland and Norway are actually the top two reporters in terms of environmental data. So they do less well particularly on the social, which then enables the southern European countries to come top overall. But so it's quite interesting seeing how different types of quantitative data is reported across different markets. But what obviously we all need, and what investors need to be able to make serious use of this data and this information, is we need better data. What you can see on the next slide is looking at the bottom part of the table. So this is looking at 46 countries. This is all what we call developed, advanced emerging, and secondary emerging countries, 46 of those. And you can see obviously two big markets here in the bottom 10. The US, with an average of 23% disclosure of data points, and China, 7%. And obviously, given the size of the Chinese market, that's very, very significant. The positive bit, so kind of the positive on disclosure, is that there is a very rapid rate of improvement. I mean, if we were looking at this back when we launched FTSE for Good in 2001, then it would obviously be an appalling state of affairs. And actually, what we've seen is year on year, some very significant improvements in reporting. This looks here at carbon emissions reporting. You can see in Europe now you've got 80% disclosure levels. In fact, actually in the UK, we're just almost 100% now with the requirements under the amendments to the Companies Act, which requires companies on a comply or explain basis to report on CO2 emissions. But high levels of carbon reporting in Europe, and it's still going up 5% per year. So that's very, very good. And in fact, actually, you see that in every market there are increases. And in the US, actually almost 60% of large and mid-cap companies reporting. And the fastest increase, interestingly, coming from Asia Pacific, and also when you break that down, it's coming particularly from emerging markets. So emerging markets rapidly improving levels of disclosure, which is excellent to see. This links to my point earlier about it's not just about the disclosure of data, it's about the reliability of the data. So there's been this movement, certainly from us, from private surveys through to requiring companies to put information in the public domain. And ultimately where we need to get to is particularly for key data points, is external verification. It's something where in our model we'll give companies more credit for where it's externally verified, but ultimately we should be trying to get towards a future where key data points for companies is verified. We have a role to play here. So in fact, I wear a kind of somewhat a dual hat. So I'm head of sustainable business for London Stock Exchange Group, and as part of that, I lead FTSE Russell's ESG business. And actually, given where we as a company sit in the market, we've obviously got an ability to try and influence this and to improve the quality of data for the market. So we went through a process initially with the Sustainable Stock Exchange Initiative, of which we're a member, and we chaired their working group to develop model guidance, which each exchange could then use to develop guidance for their own markets. And then we went through a year's process where three of our chief executive of FTSE Russell, London Stock Exchange, and Borsa Italiana, then each ran workshops for both companies and investors to try and get an understanding about what should our recommendations be in terms of reporting, what's our role, how can we help improve both the data and the dialogue along the investment chain. And after a year of work, we produced our ESG reporting guidance, which we launched back in February. Now I won't go through all of that. I'll cover a couple of I think key points. And there's a number of misconceptions which I think is worth touching on. There's a debate about kind of voluntary and mandatory. Certainly, our guidance was trying to help with the range of different reporting requirements that already exist on companies. And what's important is that in some ways we go beyond the debate about what should be voluntary or mandatory, and the debate needs to be about what information should companies be providing to investors. And the risk is where you've got companies providing kind of potentially boilerplate regulatory reporting, which doesn't work for investors. So we saw our role here as about encouraging high quality reporting, which would then meet existing reporting requirements, but making it about how best to report to investors. Another area where there can be misconceptions is about, well, was this then London Stock Exchange Group, FTSE Russell coming up with a whole different set of standards in what is a very there's already confusion around reporting standards. No, it absolutely wasn't. This is all about how can we help the harmonisation, how can we promote existing international standards and encourage companies to report on that, how can we be a driving force to help that harmonisation. It was also about, there's a concern from us about box ticking, and I think in some ways, there is actually a really important need for comparable and consistent data, and if that's box ticking, then I am a box ticker. So there's that element, but equally, this isn't about saying we've got one framework which should apply to all companies. Different kinds of companies will need to report on different kinds of indicators, and that needs to be very much part of this. And that was very much what we promoted. There also has to be a balance of smaller issues. It's not just about big companies. And equally, it isn't just about public equity. This has got to be about other asset classes, particularly fixed income and corporate bonds. We went through, if you're interested in having a look at the report, it's available on our website. There were kind of 8 chapters that we go through in terms of providing recommendations for what companies should be reporting on. I won't go through all of those now. I will just touch on what I see as investment-grade data. We do need to move away from this world of pretty CSR reports to a world where we've got hard, reliable data which can be used by investors to inform investment decision-making, to inform benchmark construction, etc. These are what we recommended in our guidance being kind of 7 key things that issuers should need to think about when providing ESG data. Again, I won't go through all of these in the interest of time. Do have a look at our ESG guidance, which is on the London Stock Exchange Group website. What I wanted to make sure I could spend the last 5 minutes on was just taking you through our thinking in terms of what we're calling smart sustainability. We carry out a survey each year of asset owners. We had over 250 respondents, and what we found is, yes, unexpectedly there's a huge amount of interest in smart meter allocations. But interestingly, 40% of those are interested in incorporating ESG or sustainability considerations into those smart meter allocations. Now that 40% actually jumps up to 60% when you're looking at asset owners in Europe. So this is not some kind of niche piece of the market. This is the core of the market, and just shows how rapidly things are moving here. I should also say, I think probably fairly obviously, that the main motivation for doing this was clearly it was not about ethics or like this was particularly about avoiding long-term risk. Now this is the framework which we've been starting to use and think about when developing what we've said is what we call smart sustainability indexes. We have a range of different data sets. And the question is how we bring those data sets together in the construction of an index. And as I mentioned earlier, you can use exactly the same approaches and techniques as you use when applying it to risk premium factors. So we've built an approach where we have built a range of multi-factor indexes scoring from size, value, momentum, volatility, yield, and quality. But what is also possible to do is then also link that together with data around companies' ESG performance, their carbon emissions, their fossil fuel reserves, their green revenues, as well as also applying more traditional SRI exclusions if there's an interest in doing so. So, I thought an interesting, just to put an example here, would be you might have a client who wants to tilt on the basis of ESG rating, wants to exclude companies with significant controversies. They want to tilt on the basis of carbon emissions, exclude companies perhaps if they've got significant coal reserves, tilt on the basis of green revenues, exclude companies with weapons involvement, and also bring in a couple of risk premium factors, in this case volatility and value. So that's kind of, I guess, an example of how you bring together potentially a range of different investment philosophies, different investment beliefs, and bring them into a single index design. Now, to put that into a real case study, we did a lot of work last year with HSBC pension funds. Mark Thompson, their CIO, got in touch in the early part of the year saying that they wanted to start to try and move on both going for a smart beta approach, but also wanting to bring in a range of factors in relation to climate change. They've got strong beliefs that climate change would have a material impact on the value of companies in the future, and therefore felt that they've got a fiduciary duty to build that into the design of such an index. They also wanted Elgin to create a fund on this, and so we worked with HSBC Pension Fund, Elgin, and also their consultants, Reddington, over a period of about a year, just under, where we then we were regularly coming together, looking at the different parameters, the different building blocks, and thinking about how to sensibly combine and bring these items together. And do that in a way that would keep it very transparent, maximise their exposure to the risk premium factors, whilst also maximising their desired exposure to the sustainability parameters. In this case, this was reducing their exposure to companies with fossil fuel reserves, reducing their exposure to companies with higher levels of carbon emissions or higher levels of carbon intensity on a sector basis while not taking any sector bets from that particular piece, and increasing their exposure to companies with revenues from green products. And so just sort of coming on to the final slide here, what this then shows is this is the index that we created, which was the FTSE Climate Balanced Factor Index. And this was used by Belgium to create the Future World Fund. And you can see the blue line here is the Balanced Factor Index. And then you can see the performances against one being the performance of the FTSE All World. So you can see a strong outperformance over the period. You can see in the green line the performance for when you add in the three climate factors. And their history here is not as long, because we've only got about 5 years worth of data history. We talked about some of the data challenges earlier. And you can see that the tracking error by incorporating these climate components is very similar. It stands less than 50 bps worth of tracking error. And it's also positive tracking error, so it's giving it an additional element of small element of outperformance. And then you can see at the bottom that the changes that gives you in terms of exposure is if you take the balanced factor index, so that's if you take the full risk premium factors but without the climate ones, you actually, by chance, get a slight reduction in reserves, but you get an increase in carbon emissions, and you get a small increase in green revenues. When you apply the three climate parameters into that as well, then you get a very significant reduction in carbon reserves, down by 90%. You get a very significant reduction in carbon emissions by 43%, and you get a very significant uplift in green revenues up to 83%. Now I will stop there and hand back to Nicholas.
Thank you very much, David, for this presentation. So it's time now for Sabine to start the Q&A with you, David. So on to you, Sabine.